Welcome to The Explainer. Okay, today we're unpacking something absolutely vital for anyone operating in cooperative finance. We're zeroing in on Part X of the 2020 SACCO Society's regulations, specifically financial performance reporting. Now, I know that might sound like just a bunch of dense legal jargon, but stick with me. By the end of this, you're going to see it for what it truly is, a brilliantly structured, living system. So, think about it. Who exactly watches a SACCO's money? When you deposit your hard-earned cash, how do you know it's actually safe? Well, these regulations aren't just red tape. They literally form this interconnected accountability ecosystem that's designed from the ground up to protect members' funds. Every single rule, every strict deadline, every designated officer, it's all a carefully placed shield.
Here's our roadmap for today. We're hitting 6 key areas: reporting rules, dividends, internal audit, external audit, the supervisory committee, and finally, approvals and penalties. Let's dive in.
All right, Section 1, Mandatory Financial Reporting Rules. You see, transparency isn't just some annual event. It's a constant rhythm. At the end of every single quarter, the clock starts ticking. A SACCO has strictly until the 15th day of the following quarter to submit their financial returns to the authority. And this isn't just a quick back-of-the-napkin summary either. We're talking a full statement of comprehensive income, financial position, and other disclosures presented exactly without deviation. It's a super tight, non-negotiable window. Why? Because it ensures the regulator always has a recent pulse on the SACCO's health.
Moving right along to Section 2, Rules for Paying Dividends.
Now, there's a really stark contrast between what is permitted and what's strictly prohibited here. SACCOs can absolutely pay interest and dividends, but it has to be based on actual financial performance, the real surplus realized. They can even set up a dividend equalization fund to act as a buffer, which is great for ensuring steady payouts even during those slightly leaner years. But, and this is a massive but, it is strictly prohibited to finance the payment of dividends, interest, honoraria, or bonuses from borrowed funds. Basically, you can't just take out a loan to look profitable and pay your members. It's a foundational rule, right? It prevents a dangerous house of cards from collapsing.
Next up, Section 3, the Internal Audit Function. Regulations 52 and 55 lay down the ground rules for this vital role. You can't just hire anyone. The internal auditor must be a fully qualified accountant under the Accountants Act. They're appointed by the SACCO and report directly to the board of directors. But the authority keeps a very close watch on this. If an internal auditor is appointed, if they resign, or if they're removed, the board has exactly 15 days to report this to the authority. And to protect their independence, which is absolutely crucial, an internal auditor can't just be fired on a whim because, say, they found something management didn't like. Their removal is highly restricted by law, and the authority can even step in to hear the auditor's side of the story.
Regulation 53 outlines a pretty massive list of duties. The core takeaway here is proactive risk management. It's way more than just checking boxes at year-end. They implement risk-based audit strategies, they're the ones directly investigating suspected internal fraud and corruption, and they constantly review the economic efficiency of how resources are actually being utilized. Plus, they have to keep the board fully informed by presenting accurate internal audit reports on a monthly basis. Essentially, they are the constant watchful eye inside the organization.
And here is where things get incredibly serious. The internal auditor is responsible directly to the authority for communicating any evidence of irregularities or illegal acts. Think about what that means. If directors or employees are committing fraud, or if officers are deliberately hiding necessary documents, the internal auditor has a legal duty to bypass all the internal politics and flag it straight to the regulator. They also have to report if they believe the SACCO is at significant risk of going under. It's a grave, uncompromisable responsibility.
Okay, let's look at Section 4, External Auditors and the Authority.
Regulation 54 lays out a super transparent 3-step appointment process to guarantee the external auditor is truly independent. Step 1, the board of directors recommends at least 3 names. Step 2, the members at the annual general meeting actually hold the power to select one out of those 3. And Step 3, the SACCO has to submit that selected name, along with the certified minutes, to the authority within 30 days. It's an ingenious system designed specifically to prevent management from just handpicking a friendly firm to audit their own books.
To maintain that strict impartiality, there's a magic number to remember: 3. A SACCO society must change or rotate its external auditors every 3 years. You absolutely cannot have the same external firm getting too cozy with management over a decade.
The only exception? If the authority explicitly grants a written waiver under very exceptional circumstances.
Now, just like the internal auditor, the external auditor acts as a crucial pipeline to the authority under Regulation 57. They share those heavy duties, reporting illegal acts, highlighting insolvency risks, and calling out officers who hide documents. But here's the kicker. They must also provide an explicit opinion on whether the SACCO's management practices and procedures are actually sufficient to safeguard members' assets and enhance financial stability. So they are quite literally judging management's competence in protecting your money.
Moving to Section 5, the Supervisory Committee's role.
Regulation 58 shows us how this committee acts as the ultimate ethical watchdog. They don't just skim the audit reports, they review the overall effectiveness of the internal controls and verify that management has actually taken appropriate action on the auditor's recommendations. But it goes beyond the numbers. They monitor the ethical conduct of the SACCO. They review related party transactions, to make sure no one is getting unfair insider deals. And they directly investigate member complaints to recommend redress. They are, without a doubt, the member's voice inside the governance structure.
They also have to follow a very rigid reporting pipeline. After the end of each quarter, the Supervisory Committee prepares its report. Within 30 days, they present this at a joint meeting with the Board of Directors. Then, within 30 days after that meeting, all those quarterly reports, plus whatever comments and actions the board took, must be submitted straight to the authority. So nothing gets swept under the rug. Nothing.
Finally, Section 6, Approvals, Penalties, and Compliance.
Regulation 56 dictates the exact sequence for handling year-end financials, and it's absolutely critical. Step 1. Within 3 months after the financial year ends, the audited financial statements must be submitted to the authority. Step 2. The authority has to officially approve them. Step 3. Only after that approval can the board present these statements to the members at the annual general meeting, which, by the way, has to happen within 4 months after the financial year ends. The board absolutely cannot present unapproved financials to the members. No shortcuts allowed.
So, what actually goes into those approved copies submitted to the authority? Far more than just a standard balance sheet, I'll tell you that. It requires a signed statement of director's responsibility, the auditor's formal opinion and key audit matters, detailed cash flow and equity changes, a systems audit report, and a business sustainability report. It's essentially a comprehensive X-ray of the organization's entire operational and financial reality.
Now, what happens if management decides to play fast and loose with these rules? Well, under Regulations 56 and 59, any officer who willfully causes a SACCO society to violate these reporting regulations is liable to pay a financial penalty of up to 100,000 shillings. It hits non-compliant officers right in the wallet.
But the stakes go even higher than that. Contravening the provisions of Part X is an offense that can actually result in imprisonment for up to 12 months or a fine or both. This accountability ecosystem has teeth, and the law fully intends to use them to protect member deposits.
So zooming back out to the big picture, I want to leave you with this provocative question. Is your SACCO's accountability ecosystem actually robust enough? We've seen how the internal auditor, the external auditor, the supervisory committee, and the authority are all deeply interconnected by strict timelines and heavy legal duties. They're designed to work together perfectly, like gears in a machine. As a stakeholder, you have to ask yourself, are all those gears turning seamlessly in your organization?
To ensure you are flawlessly applying these regulations to safeguard your organization's future, we're here to help. For specialized consulting on these matters and to see how this roadmap fits your organization, please reach out directly at 010-719089.